talk to you. Okay, IS 37. Are we there?
Yes, sir. We are here.
Listen. Listening.
Yeah. So we have
Hello?
provision, contingent liabilities, and contingent assets. Now,
Hello, sir.
yes, sir. Go ahead, sir.
Thank you, sir. I have just a question. Is there any calculation related questions that we may likely be looking at for this IAS 16 and IS 40 and the intangible assets so as to, be in the know of what to expect, in the exams? Though I
So
missed
yes,
the
sir.
class, but from the material, I'm seeing that it's more like, theories. Is there any calculations that we may likely look at?
Yes, there are calculations we can look at, sir. All right. So one thing
Yeah.
about IS 40 and the rest is that the IS 14 doesn't work alone. Do you understand? It doesn't work alone. It works with other IAS, right? And now when we have these other IAS, sometimes they test it with other questions and then you have to apply. And sometimes they'll give you short questions that has IAS, that has investment, that has provision, and the rest of them. So, and I mentioned this last week as well. So what happened is that we can't do IS 16 only and leave others. So I actually want us to complete this whole topic. Once we are done, we can look at a Pathfinder question for it. Are you with me,
Okay,
sir?
sir. Yes, thank you so much.
So we can look at the Pathfinder question for it and then we solve. So all of them, you will see them starting, at least I have from November 2020. I have from May 2015 to November 2020. Questions on IS 16, IS 20, 23, and 14. Right? And there can be more of it like that, including IS 37. So yes, there is a question on it. And we will solve that question once we are done with all of this.
Okay, sir. Thank you so
Yes, sir.
much.
All right, sir. Now, so we have for IS 37, a provision is a liability of uncertain timing and amount. Right? So that's why I usually say that all provisions are liabilities. Someone said tax is going on. I'm sorry, if tax is going on, just do it, tax. You can join us when you are done. Now, provisions are liabilities, but the timing and the amount of that liability is unknown, right? And of course, a liability is an obligation, a present obligation arising from past events, all right? And this past event and that obligation is expecting us to pay, or it will lead to an outflow of resources. It will lead to a decrease in our resources, outflow of our resource or our resources. Right? Now, this obligating events that can arise are events that create a legal or constructive obligation. And this event leaves no realistic alternative to settlement. Right? Yeah, it's a legal or constructive obligation that leaves no realistic alternative to settlement. So provisions are different from liabilities, of course. And the difference is that it is uncertain in amount and the time of payment. So that's it. Now, how do we recognize provision? 3 conditions must be met before you can recognize provision. The first thing is that there must be a present legal or constructive obligation that has risen up from past events. All right, yeah, there must be an obligation that has risen up from past events. And this obligation will result to probability of outflow of our economic resources or outflow of economic benefits to settle that obligation. All right, so that's it. And there must be a reliable estimate of the amount that can be made. Don't forget, it is uncertain. The amount is uncertain, but there can be an estimate to that amount. So if any condition, if any of these 3 conditions is not met, any of them, even if 2 are met and 1 is not met, then it's still not a provision. Until the 3 of them are met, before you can recognize it as a provision. How do we measure provision? We can use best estimate for provisions, right? So when we're doing our accounting estimate, changing accounting policies and accounting estimates, right? So we can use best estimate to reflect the expenditure needed to settle that obligation. For instance, if you have a court case will tell you that, okay, if we lose this case, the sentence or the punishment or the penalty is between this amount and this amount. They're giving you the range of punishment, the range of penalty, right? Now, your lawyer will look at the issue and tell you that, but most likely, this is what the chief judge will give as verdict. Most likely, don't forget, your lawyer is not the judge. It's just only forecast. It's just giving you the best estimate based on his knowledge, based on his experience and expertise. Are we together, please?
Yes, sir.
Now, if time value of money is material in that respect, let's say, for instance, the settlement is not this year. In fact, the settlement can take up to 3 years, right? Now, in a situation like that, and the amount is huge, then it should be discounted to a present value. Also, we can have, when you are discounting it, right? You discount the expected outflow using pre-tax market rate. The market rate before tax. And that's it. Now, you can review this, not even count. You must review this estimate annually, right? To be sure that you are still in the same picture. To be sure that you are getting it, right? The same way we estimate we check the market value of our assets. It's the same way we check the value of our liability as well. So every year you must check it. All right, that's it. Now, also there can be a change in your provision, in your estimates. The same way we can have revaluation, we can have a surplus or a deficit. All right, the same way we can revalue our asset upward and downward. This also can be revalued. And that estimate, this one is not revalued now. You look at the estimates. Now, when the estimate changes, right, you also change your provision. If that change in provision leads to an increase in your provision, then that's an expense. You expense it. If it leads to decrease in provision, then you credit it. All right. So that's what we have there. Now we have reimbursement. Now for reimbursement recognizes a separate asset. So when you are recognizing reimbursement, you recognize a separate asset. Okay. Now you recognize it separately only if the receipt is virtually certain. When it is very certain that you will get back your money, yes, you recognize your reimbursement. And there is no offsetting with the provision in the statement of financial provision. Reimbursement cannot offset provision. So what do we use provision for? We use provision only for the specific expenditure originally recognized. All right, for that expenditure that is originally recognized, that's what we use provision for. And excess provision can be reversed. So when you recognize an excess provision, you reverse it and recognize that reversal as income. In the same way, when you recognize impairment, excess impairment, you can reverse it, right? You can reverse it and record it as an income. And that one, for what's it called? For impairment, you can offset. The impairment can offset. Now, when you have an insufficient provision, you recognize additional provision. All right? Additional provision and recognize it as an expense. So that's it. Any question, please? We can proceed, right? Okay, I'll take that as yes. Now we have specific guidance areas. Now we can have a one-off contract. They call it turnkey projects. All right. Now for a one-off contract, when it is an unavoidable cost, when an unavoidable cost is greater than benefit, I'll take it again. When your unavoidable costs, you know what unavoidable costs are? Am I right? You know what unavoidable costs are, Abi?
The cost that you must incur.
So your unavoidable cost is a relevant cost. Abi, is it a relevant cost?
Yes.
No, sir, it's not
Yes,
a relevant cost.
Don't say yes, you. Don't say yes. You.
No, sir.
A
Not
cost
a
you
relevant
cannot
cost.
avoid is a fixed cost. Whether you produce or you don't produce, you can't avoid it. That's what makes it unavoidable.
Okay.
So your unavoidable cost is an irrelevant cost. Now, when you see that your unavoidable cost is greater than your benefits, you recognize provision for that excess of costs over the benefit. All right, so that's it. Recognize provision over it. The excess, only the difference. So, all right, yeah, only the difference. Recognize it. Now, here we have future operating losses. Future operating losses, right? Now, for future operating losses, do not recognize provisions. Hello? You will incur a loss in the future. You have not incurred the loss, so you will incur a loss on your operations in the future. Let's take, for instance, you want to produce next year And in that production, you have envisaged it that there will be a loss. You not recognize provision now because you're not producing now. You wait till that period. Do you understand? So that's it. Now, when you are restructuring, provisions can only be made if a detailed formal restructuring plan exists. One, if you are making a provision on restructuring, there must be a document to guide it that there's a restructuring plan. Number two, there is a valid expectation in terms of announcement or implementation. There is a valid expectation on that restructuring. Now, for future repairs and overhauls, you have to recognize it only if there is a present obligation. Only if there is a present obligation that will result in that future overhaul, future repair. Are we together, please?
Yes. Yes, sir.
Okay. Now, in a situation like that, if it is a normal repair, you expense it. If it is replacement or overhaul, you capitalize it, right? Overhauling is a capital project, I mean. Am I right?
Yes, sir.
So that's it. Now, contingent liabilities and assets. Contingent liabilities and assets. Now, contingent liability is also a liability. But the liability can be two types, right? Now, it can be something, you can have a possible obligation if it is confirmed by uncertain event. Contingent liability is that you will be liable if that thing happens. Do you understand? If that thing happens, you'll be liable. So where there is public possible obligation, and that possible obligation is confirmed by uncertain future events, then you recognize. Now, if there is present obligation, you do not recognize due to low probability or unreliability estimates. When you don't have enough assurance, enough estimates, you cannot recognize. Now, the same way we can have contingent assets is the same way you can have contingent liability. Please, are we together?
Yes, sir.
Now, for contingent assets, when there is possible asset, is that if that possible asset is from past events and the realization depends on uncertain future events, is from past events and getting that asset is not sure, is based on uncertain future events. All right? Yes. Then you can have it as a contingent asset. Now, neither contingent asset or contingent liability is recognized in the financial statement. There is no room for contingent assets or contingent liability in your income statement or balance sheet. Right? You can only disclose it in the notes if the inflow or outflow is probable. All right? So that is it. Now, the application and judgment areas. Things you need to consider Eh? Before you can determine your judgment areas now, before you can determine what will be, whether it's a liability or an asset. All right. Now, you need to check whether an obligation exists. All right. Are we there?
Yes, sir.
Yes, sir.
Okay. Now, judgment is needed to determine whether an obligation exists. So sometimes you make use of your own personal judgment, professional, not personal, professional judgment. Then also you need to look at the probability of outflow, probability that you make payment, probability that you'll be liable. Also, look at the reliability of the available estimates. Is it reliable? Then also look at whether restructuring qualifies. All right? And differentiate between future loss and onerous contracts. Then also measure it accurately. Okay, measure it accurately. Now, these are what we have. So we have the recognition criteria summary table here. Now, the additional summary table we have, all the summary tables, please go into them. Now, impairment of assets. Impairment is when the recoverable amount is lower than the carrying amount. And I'll take that one. I don't want you to memorize it. All right, I don't want you to memorize it. Now, your carrying amount is the amount you have in your balance sheet as the value of your asset. If you say your asset is worth, oh, are we recording? Yes. If you say your asset is worth 20 million naira, and then they went to the market, they told you that if you have to sell this amount, this asset, oh, the amount you can get from that asset is 15 million naira. Does that not mean you are playing with your assets? Right? So it means you are playing. So what you have to do is that your carrying amount is wrong. You have overestimated your asset. You have over-recorded your asset in your balance sheet. Because what they can recover if they sell the asset now is less than what you are recording it. So that one is impairment. All right? Now, this impairment you are talking about, you've considered depreciation and all of that, and your carrying amount, you are still having the recoverable amount to be more. Now, your recoverable amount itself is the fair value less cost to sell or less cost of disposal, anyone you want to call it. Right? The higher of this fair value, that is the market value, less the cost you would incur when you want to sell the asset, as well as the value in use, whichever is higher, is your recoverable amount. Now, IAS 6 applies to all assets except inventory, IAS 2. Deferred tax assets. It's a different tax. So, our deferred tax does not impair. Then also, for financial assets, there's no impairment for financial assets. Right? You pay the face value of that financial asset, except if there is a negotiation on charges and all of that, which is not impairment. Then also, where you have investment property at fair value, IS 36 will not apply. Also, when you have non-current assets held for sale, so that's what you have. I hope we can proceed, please.
Yes, continue, sir.
Okay. For impairment, like we said, impairment is when your carrying amount is greater than your recoverable amount. The recoverable amount is the fair value less cost to sale, right? And the value in use, the higher of the two. Now, impairment loss is when your carrying amount. Your impairment loss is your carrying amount minus the recoverable amount that we have said earlier. Now, we have this for cash generating units. And a cash generating unit is the smallest group of assets that generates cash inflows independently. An asset that generates cash inflow independently. That's it. Now, we have stages in accounting for impairment loss. Accounting for impairment loss. Tomorrow is Wednesday, right? Okay. Now, for your impairment loss, you need to assess the indication of that impairment loss. What is that thing? The indication of the impairment. What is that thing that shows that your asset has impaired? That is, the carried amount of your asset is more than the recoverable amount. What is that thing? Assess that indication. Then also, you need to estimate your recoverable amount if impairment indicators exist. All right? So look at your recoverable amount, which is your fair value less cost to sale, and the value in use, the higher of the two. Then, of course, compare that recoverable amount to your carrying amount. Recognize the impairment loss if the recoverable amount is lower, right? And adjust your future depreciation based on the revised value of the asset. That is that. Now, once you are done with this, whatever you have done, you need to disclose it in your notes to the financial statement. All right? You disclose relevant impairment loss details in your financial statement. Now, the indicators of impairments that we said. The first one we have there, we can have the external indicator, we can have the internal. Now, the external indicators are unexpected decline in market value. Suddenly, the market value of your phone is reducing unexpectedly. Ordinarily, during Tinubu's regime, your assets get more expensive, Abi. Am I right? What you bought in 2022, in 2024, in 2023, it increased. In 2024, it increased. In 2025, it increased, Abi.
Yes.
Yes, sir.
In 2026, is it still increasing?
Yes, sir.
You will learn. You don't know anything. You think it's increasing? Okay. Have you checked the exchange rates recently?
I don't think it's affecting the market something.
It depends on the product.
Well,
It depends on the product. Now, most of these our electronic items are being imported. Our cars and the rest of them, they are being imported.
yes.
Right? So someone who bought it at an imported price, there's no way you want to sell it because you convert it to Naira. I'll not be in Nigeria here, and you'll be selling a car to me in USD, and you are in Nigeria. I will ask you where you expect me to see the USD now. If you are saying I should go and change it from BDT, no problem. Now you go suffer because the exchange rate now is falling.
Yeah.
Right? An exchange rate is around 1,300,
Is something. Yeah.
348 or so. So which means those things are getting cheaper. The prices are falling down. And again, the last CBN had their meeting yesterday, and they reduced the MPR by 5%. I mean, by 0.5, sorry. 0.5, 50 basis points. Right? So that is that. Please, if you have been keeping dollar before, now I beg the same is take $2. Honestly. Now I'm begging. Those of you who reaped our naira, those of you who saved the USD, because USD was increasing then, I pray you still save that USD. Now that it's falling. And now, maybe you reaped Nigeria and you reaped all of us. Let us reap you too. Anyways, that's that. Now, so when there is an unexpected decline in the market value of your product, then of course, it's an indicator that there is an impairment. Right? For instance, let's say my car was 10 million naira, Toyota Venza. Well, then Toyota Venza was around 60 million. So let's say my Toyota Venza is 60 million naira. Then all of a sudden, the market price is now at 12 million naira. Hello, where will I get the remaining 4 million naira? That's it. Then also, when you have technological, legal, or economic changes, changes in technology can render your items, your assets useless.
Yes.
And I just see that the world stopped using it. And what did I do wrong? Technology killed BB. Technology killed BB.
Okay.
So that's it. I'm sure BB tomorrow they are still regretting this. If they had known, it would have improvised. So that's it, by the way. Now, we also have market capitalization below the net assets. All right, and that's it. Now, for the internal indicators, we have physical damage. If you buy an asset, if you buy a phone now, and then the screen got damaged, and that's not the price again. Price change. Then, of course, when you are restructuring, when you have a restructuring plan, or you want to discontinue the use of an asset, and that's also an indicator. As I said, you are saying that no, and for the new Nigeria we are going into, we'll not be needing all these assets again. That's a physical and internal indicator. It's the business that is causing that. Right? You can also have poor performance versus expectation. When your actual is lower than your projected. And the last is that when the asset lifespan reduces, when the asset lifespan reduces. For instance, power bank. Anyhow, I don't know. I don't know how you want to use a power bank. For ordinary, power bank should spend 1 year. Like ceteris paribus. Power bank should spend 1 year. All of a sudden, your power bank is not functioning. Right? Probably electricity has destroyed it. So that's it. That means it has reduced the useful life of that asset. So that's it. Now, how do we measure this recoverable amount? Remember, we have recoverable amount is fair value less cost of disposal or cost to sale. Right? Cost of disposal. And we also have the value in use. Now, when you're measure your fair value less cost of disposal using the market-based price. Using market-based price. All right. So that's it. Now, or estimated if there is no active market for it. Estimated if there is no active market for it. Are we there?
Yes, sir.
Okay. Now, another way is that you look at the direct selling cost. All right. Direct selling cost of that same asset. Now, if there is a legal fee, look at it. If there is tax, include it as well. That is to measure the recoverable amount. Now, the second part of the recoverable amount is the value in use, Abby. And for value in use, estimate the future cash flow, including the disposal, right? The future cash flow from that asset. That's number one. Number two, discount it to the present value. Do you understand? That means you will need a discounting factor to do that. Now, your discounting factor should reflect the asset's risk. And that is that. I believe strongly that we understand NPV. And we understand discounting factor as NPV.
Yes.
Aha. So that's it. Now, you discount your future cash flow to present date. And the special requirement is that there are some assets, intangible assets that must be tested for impairment annually. It's just like you waking up like Abasha, Sunny Abasha, Sunny Abasha, Sunny Abasha, and asking Al Mustafa, are we still in power? For you to annually, you need to check your goodwill if it is still in power. All right, even without any indicator, you need to test your goodwill for impairment to check whether you are still in power. All right, your goodwill, other intangible assets, definite useful life. What are those assets with definite useful life? All from goodwill. Oyana, what are they?
Is it?
What are those what are those intangible assets that have indefinite useful life? What are they? What are they?
Copyright.
POS?
Patents.
What do you call it?
Copyright, sir. Copyright.
Copyright is not indefinite.
What of trademark?
It's not indefinite. All those intellectual properties are not indefinite. Be careful of what you say. I'm speaking to a lawyer or to a lawsuit. Okay, I'm not a lawyer, but I'm a lawsuit. So be careful of what you say. Copyright and patent rights. Just like I heard that this guy, VDM, has now copyrighted this slang, this word, blood.
Lord.
So anyone who says blood now, VDM hears it, they can sue us. And this class is being recorded. Though. Just imagine VDM checking our recording, and then he hears us mention blood. One name, you are using it for example for teaching purpose. So we cannot be sued. He cannot even get shishi from next gen. So that's it. That one is a copyright. But copyright, all of them, they are not indefinite. Right? They are not. They are not indefinite. I think many of them are. It depends. Some are 7 years. It depends on the number of years you also copyright it. Sha. Now, there are some of the copyrights, for instance, artistic copyrights. like your song, if you write a song or a movie, that movie has a copyright of throughout when you are alive and 70 years after your death, throughout your existence. That is for artistical. Like you wrote a book, or you wrote a script, or you wrote a movie, or you wrote a song, and none of that line can be used while you are alive if it is copyrighted. While you are alive and 70 years after you've gone. So they are not indefinite. So which one is indefinite? Yes, anyone? Anybody who
Goodwill.
wants to try?
Goodwill.
And we've mentioned that goodwill before now. Any other one, please? None of us. So this is it now. Usually, just like I said, your intellectual property. Now, there are some brands. There are some of your brands. There are some of your intellectual properties that will continue to exist as long as the business is existing. Brands. All right? Or trademark.
I said it the other time now. You said it's not indefinite.
Okay. I was actually talking about copyright. Now, there are not all of them. I'm not saying all trademarks.
Okay.
Trademarks cannot be forever.
Yes.
Yes, trademarks cannot be forever. I am very sure. Because trademark can be a design, it can be a logo. It can be forever. As long as the company is existing. As long as the company is existing, that will be the trademark of that company. For instance, let's take Apple. As long as Apple is existing, then that they are Apple. That's Suarez was here. For those of us who watch football, that's Suarez Apple. We continue to be their trademark as long as the business is existing. Because that is the mark of their business. And as long as that business is existing, the mark also exists. All right? And you don't do a trademark for fun and then just dump it. I've trademarked this thing, nobody else can use it. It's a lie. If you don't use it, it can be retracted. All right? Yes. So your copyright, like I said, has a period. Do you understand? Even your franchise, although franchise can have exclusive rights, and that's why you pay for that franchise. What is franchise? Franchise is that you want to set up your own business. You'll be using the name of my business. You'll be using my setup. You'll be operating in the way I have stated, the way I have laid it down to be followed. My lay down guidelines is what you want to follow. So as long as I'm existing, then yes, my franchise can also exist. But once the business dies, that's the end though. The same thing to business domain, like business names. Are we together? So your copyright, don't forget, I mentioned that copyright is, if it is like artistic one now, artistic copyright, as long as you are alive, and 70 years after your death. So 70 years after your death, someone else can use it. Is that now indefinite? It can be indefinite to the owner, but not indefinite to the owner. So that's what we have. Now, so you must, That's your impairment at all times. That's your goodwill. And we see the power. Do we still have that power? For instance, if we are using the goodwill of Dangote name, we need to check it every year. Are people still feeling us? Do you understand? So that's it. Now, we have cash generating units, which you mentioned before. All right. Now, these units are used when an asset does not generate cash flows independently. All right. When an asset is not generating cash independently, impairment testing is done for that cash generating unit level. And goodwill must be allocated to cash generating units or tested at entity level. So you must test your goodwill, except if your goodwill is a cash generating unit. So that's it. Now, allocation of impairment loss in cash generating units. How do you allocate impairment loss? Don't forget, your impairment is like an overhead too. For PM. It's also like overhead, whereby you need to allocate it. All right? And this one is not apportionment though. So now, allocation of impairment. Impairment will reduce goodwill, of course. Right? So now the first thing is for you to reduce your goodwill and then allocate it to other cash generating unit assets on pro rata basis based on the carrying amount. Now, an asset value cannot be reduced below the fair value less cost to sale and or below the value in use or below zero. There's no way you will tell me that the value of your asset is -2 naira. It's not possible. Right? Then also it can be on fair value less cost of disposal. And it can as well be the value in use, which means you look at the future cash flow and then you discount it. All right? That's what we have there. Now, I hope we can proceed.
Continue.
Huh?
Let us continue.
Okay. Now we have monetary assets. Your monetary assets cannot be impaired. For instance, debtors, creditors, your cash in hand. There is no impairment that will touch your cash in hand though. If your currency is torn, then it is torn. I need to go and look for sellotape or super glue to come me back. This is Nigeria. Now, impairment can be reversed. I think I mentioned this earlier too. Impairment can be reversed. When you have an impairment before, and there is a new information that justifies improvement in that asset. An asset that has impaired before, that you have recorded as for impairment before. There is now a new information that says that that asset is now being used. Let's say before you left it because of technology. Now technology has come back to it. Right? So that one, you can reverse your impairment. All right? Now, you cannot increase your carrying amount beyond what it would have been without pure impairment. That is, you reverse your impairment now. Let's say before, the value of your asset was 10 million naira. Because of impairment, it came down to 6 million naira. Now, there is a reversal in that impairment. And then you have to take it back. They are not telling you that, you see that asset, the asset is now at 15 million naira. My brother, you cannot record 15 million. No. You cannot reverse it to 15 million. You can only reverse it to that 10 million. That is reversal. All right? So your reversal goes to your PLN account. Unless the original impairment was in OCI. And when you have the original impairment in OCI, Eh? Unless if your original impairment, you have recorded it, you had recorded it in other comprehensive income. That is when your reversal will also go to other comprehensive income. Goodwill impairment cannot be reversed. If you have lost your reputation, you have lost it though. It will not come back. It will not be reversed. So that's it. Now, you have to disclose your impairment. All right? You have to disclose an amount of impairment loss. If there's any reversal in your P&L account or OCI, you have to disclose them. You have to disclose the nature and reasons for that impairment reversal. Why did you reverse it? What information? That is if it is material. Materiality is very much important here. Also, you have to disclose the methods you have used to calculate that recoverable amount. The fair value less cost of disposal, or the value in use. You must tell us the method you have used to arrive at that figure. For cash generating units with goodwill or indefinite life intangibles, you have to disclose the assets, the assumption you have used. Are we together, please?
Yes, sir.
You have to disclose it though. The assumptions you have used for that goodwill or indefinite life intangibles. All right. Then also sensitivity of estimates. What's sensitivity analysis again? Hello.
So we're here.
I'm asking a question here. I'm not asking if you are there. What is sensitivity analysis?
So let me try.
Oh, yeah, try now.
Sensitivity analysis is this to determine if there is a change in a variable, a ratio of change in variable.
Change in variable. What happens to that change in variable? So if there's a change in variable, what happens? What makes it sensitivity?
So the change, the change could be positive or negative change.
If it is positive, then it is not sensitive. We are looking at the change that can happen to any of your variables, and that change will threaten you achieving your corporate objective. Change that will threaten your corporate objective. That's what we are saying. All right. So that change, for instance, can be, let's say, what happens if there's a change in my selling price? Will I still be able to achieve my profit, my objective, my profit objective? If it doesn't threaten your corporate objective, then it is not sensitive. And that's why you're saying that, for instance, that's why you are always thinking pessimistically when you are doing sensitivity analysis. That is, what if, that's why we call it what if analysis. What if my revenue is not as much as I have budgeted? What if my expenditure is more than I have budgeted? So we are trying to look for those things that can lead to loss and not profit in the business. That's sensitivity. Thank you for that. At least you tried. Now, so for cash generating units with goodwill or indefinite life intangibles, And you look at the assumptions that you have used and the sensitivity of that estimate. All right. So just like I said earlier, those indefinite life intangibles, right? There must be something that, apart from goodwill, the rest of them are intentionally applied for life. Do you understand? Just like the trademark that I said. And now, how do you know if an asset has an indefinite life intangible? I mean, indefinite life. For instance, when we mention that trademark, and I mentioned Suarez apple, you have Adam's apple, you have Suarez apple. I mean, you have other types of apples. Now, those intangibles, that trademark, if you want to know if it is indefinite, it means that the cost of renewing it is cheaper. See, those trademarks that you see, they renew them. This one, blood, that this guy said, VDM, he has to renew it if he wants it to continue. If not, I think 7 years or so. My guy at the top, do you know it was trademark? No. Is it trademark? No. Was it trademarked? My guy at the top, was it a trademark?
No.
What was it? Oga at the top was trademarked. Oga at the top, it was trademarked. Yes, that guy trademarked it. That anyone who called Oga at the top that time will be sued to court and the guy will collect money. Yes, I'm actually writing. No, I've not started. I actually intend to write a project, a dissertation on awareness of these what do we call it? Intellectual properties and intellectual property laws in Nigeria. Yes, I'm working on that project. Now, those things, you need to apply for them. You need to renew them. If it is something you have to renew annually, so would you call that indefinite? No. But as long as you continue to exist and you are paying for it, then it becomes yours. So that is it. All those things, they are applied for, right? You can do a trademark with unlimited legal protection, right? You can have a brand name that will stick with you forever. Even if you are not using that, even if the business closes down, nobody else can use it. For instance, Coca-Cola. You think anybody will use Coca-Cola? Or let's say Dangote now says that, okay, all Dangote businesses, may God forbid, all Dangote businesses now, they are now sold and they are now using another name. You think one person will now go and absorb that name, Dangote? Nobody can do that. So sometimes it can be something you apply for. The brand name can be done perpetually. Anyways, that's that. Now the judgment and estimates under IS 36. IS 36 requires the use of significant management judgment and estimation technique. All right? Significant management judgment and estimation technique. IS 36 has it. And this can materially affect the impairment figures in the financial statement. All right? Now, management judgment and estimates can materially affect impairment figures. So I can use a method that will give me high impairment level because I want to reduce my profit and I want to reduce my tax. It depends on whatever motive I want to use it for. All right? So that's it. Now, assessing the impairment indicators. You remember all the external and the internal indicators? Can someone remind us? External and internal indicators. What are they?
External indicators include unexpected decline in market value,
Uh-huh.
technological, legal, or economic changes, and then we
Uh-huh.
have market capitalization below new assets. Then for internal indicators, we have fiscal damage or obsolescence, we have restructuring plans or discontinued use, we have poor performance versus or expectation. Then we also have reduced useful life.
Thank you. Thank you. Now,
Thanks, sir.
when you want to assess the impairment indicators, you need to judge whether the internal or external indicators of impairment exist at the reporting date. Look at those indicators. Do they actually exist? Then also, that judgment, before you can assess that impairment, that indicator, it requires both qualitative and quantitative evaluation. Check it in quantity, check it in values. All right. Then also, an example of this is when we say a decline in market demand, right? Check whether there is actually a market demand, a decline in market demand. Either customers are not buying our product. Why? Or do we have a legal dispute? Right? Now look at it. What's the implication of customers not buying our product again? What happened? Do you understand? So, and assess the indicator itself. And that's it. Now, also you determine the fair value less cost of disposal. All right. Now, in the absence of an active market, because when there's an active market, you use the value, the market value. But where there is no active market or a binding sale agreement, you as an entity, as the professional, must estimate the fair value using level 2 or level 3. Hello? Using level 2 or level 3 of valuation techniques. An example of these levels is when you use a discounting factor, a discounted cash flow. All right? So that's it. Now, another thing is that you introduce subjectivity. Once you are doing all of this, once you cannot get a market value and or a binding agreement, a sale agreement, any other estimate you are using, is subjective. How do you know it's subjective? Number one, your discounting factor. You can decide your discounting factor by yourself. You can decide that you want to use the current market, current interest rate. What's our interest rate now? Starting from yesterday, what's our interest rate? Our interest rate is now 25.5%, as against 26% before. Right? Now, which means you can decide that you want to use the interest rate. You can decide that you want to use another rate that is closer to it. So that's it. But any rate you are using, it is still subjective to your own estimation. And the estimation is uncertain. Do you understand? The estimation is still uncertain. Do you have any question, please? Do you have any question? Huh? Okay. Now, estimating the value in use it. The value in use now. Okay, we are almost done. We'll complete this chapter before we leave. Now, estimating the value in use. Don't forget, value in use makes use of what do we call it? Cash flow statements. Cash flow, NPV, right? So you need to project your future cash flow from the assets. Then select an appropriate discounting rate. You're already being subjective. The discounting rate that will reflect the time value of money and asset-specific risk. All right? Then, both elements, like we said, relying heavily on forward-looking. You need to look at the future. Forward-looking assumption and economic forecast. So if you have been forecasting that interest rates will continue to increase, now interest rate has started reducing. All right, so that's it. Now you have to identify the cash generating units. Now this one requires judgment in grouping your assets that generate largely independent inflows. All right. Now, entities may have discretion in defining their CGU boundaries based on business structure, market dynamics, or internal reporting. I can say that my own CGU is any asset that gives me up to 10 million naira in a month. Someone can say that if it doesn't give me 100 million in a year, I will not recognize it. But 10 million is already looking at 120 million. So it is subjective. And entities are at discretion. Now, allocating this goodwill to CGUs. Goodwill must be allocated to CGU or group of cash generating units that are expected to benefit from that acquisition. Oh gosh, I hope you are understanding this thing. Your goodwill must be directly allocated to a cash generating unit. If that cash generating unit will benefit from the acquisition of that goodwill. So which means if I'm buying a business and I will enjoy the goodwill of that business, you know that literally for your SBL in your consolidated financial statement, literally what goodwill means is that the value of this business is 1 million naira and I'm paying 1.2 million naira. The 200,000 excess that I'm paying is your goodwill. There must have been something about the business that I feel will pay me back my 200,000. If it will benefit me, then yes, goodwill must be allocated to a cash generating unit. Now, this allocation affects subsequent impairment testing, and it is based on strategic judgment about the synergies and cash flows benefits. So I'm looking at the synergy I will get from this business and the cash flow that will come into my business. Please, I hope we are together.
Yes, sir.
So that's what we have. Do you have any question? God so good. We finished at 10:20. Do you have any question before we wrap up?
Yes, sir.
Go ahead, please.
So please give an example of cash generating units.
Yes. Anybody there can give us example? Anybody? Hey. I've mentioned one today. I mentioned a business now that in your consolidation, a business is worth 1 million, and I said I'm buying it at 1.2. Right? That is a goodwill. That goodwill is attached to the cash generating unit.
PP, what of PP?
Sir, please speak up.
I said PP.
PPE. Yeah. Now tell us how PPE can be in cash generating unit.
As in a
which
specific,
PPE?
For example, can't remember.
Your PPE, your plans.
You said?
your plant is a cash generating unit.
Yeah.
Your plant, plant and equipment is a cash generating unit. A business segment, a business division can be a cash generating unit. If that division
What of
is
motor vehicles?
significant, sorry,
I said, what of motor vehicle?
it depends on if it is giving you cash generating, if it is giving you cash.
That's okay. As in using it for transportation business.
When you are using a motor vehicle for transport, is it PPE?
Oh, it's not PP. Sorry.
No, wait
Can
now.
can we say a smallest unit of an
I'm
asset
coming.
can
Let's
generate
analyze that. Hello,
cash independently?
hold on, sir. You will come back to that. I'm saying a motor vehicle that is used for Uber driving.
It's investment properties. Sorry for that.
Why do you call it investment property?
Because it's generating cash, I mean income for the owner.
Uh, uh-huh. So you call it investment property?
What can we call it?
Eh? I'm asking you, all of us are not talking. It's time for us to talk.
So it's investment property
Why do you call it investment property?
because it's used to generate income for the owner.
Is investment property meant to generate income for the owner?
Profit.
Eh?
It's meant to generate profit.
Investment property? No, now. There are three things that you can see in an asset before you call it investment property. What are they? Investment property, number one, it must be generating rental income.
Okay.
Is your Uber car generating rental income?
No.
No. Number two, it must give you capital appreciation. Does it increase the value of your car?
No.
So definitely it's not investment. Number three is that it must have the two. Number three is if it has the two. So definitely it's not investment property. Would you call it an asset held for sale?
Is it?
Would you call a motor vehicle, a Uber car, as an asset held for sale?
Right for six.
Are you using it because you want to sell it? No.
No.
Is it
No.
an inventory? Is it an inventory?
It's not inventory.
It's
No.
not inventory because
No,
you didn't buy it to resell it.
Yes.
Is it PPE?
It's PP.
It's PPE. Why? Why?
Because the benefit is flowing to the
One, there's probability that future economic benefit is flowing into the owner, into the business itself. One,
and the cost can be
the cost can be measured reliably.
Reliably.
Uh-huh. So that is it. Even if you are the one using it for administrative purpose, or even if you are the one occupying it, it's your asset. Abi?
yes.
Uh-huh. Yes, someone was saying something before. Let's hear you, sir.
Oh, sorry. Okay. Is it okay? When you were asking us what gas generating unit is, and I wanted to say it's like the smallest unit of an asset that can generate cash independently.
Yes. So that's a cash generating unit. It can generate cash independently on its own. All right.
Okay.
So let's take for instance, if,
I said unfortunately
You
I'm
can
still
hear
on
you,
the
sir.
road. I don't know if you heard what I said. Okay, I said the smallest unit of an asset that can generate cash flow independent.
Yes, sir. You get that definition too, sir.
Sir?
Yes, we got the definition, sir.
Okay, thank you, sir.
So that's it. Any asset. So examples now, right? So like I said, a business segment or a division, your plant, your PPE, right? If it generates cash, then that is it. An outlet, even a retail outlet, do you understand? All these are cash generating units. All right.
Yes, sir.
So that is it. Any other question?
Sorry, sir. Please, this is not really a question. Sorry, I was a bit down last week, so I didn't join. I didn't have the opportunity of joining class all through last week. I was in and out of the hospital. Sorry about this. So, but trying to download the the materials. Uh, the I tried downloading one this evening, and it's saying that the material is blocked. I don't know if
So you reach out to
that
the admin. Admin will
okay.
handle that. Reach out to the admin. Any other question, please? All right. In the absence of any, good night, everyone. I'll see you all in our next
Well,
class.
Thank you,
Good
sir.
night.
Good
thank
night,
you.
sir.